The options that are being considered by governments around the world are, number one, to nationalize the banks, number two, to provide some additional insurance to bank assets. In other words, let the banks take the first hit on a percentage of those assets, and the governments will insure the balance. And the third is to set up an aggregator bank, sometimes called a bad bank, which would be managed by the federal government or the central bank in that country to take on the toxic assets within those banks. So those are three options that seem to be on the floor right now that are being considered with different levels of earnestness depending on the country we're in. For all intents and purposes, if you look at the share prices of banks in the US and the UK right now, we essentially have de facto nationalization because the common shares are worth nothing, almost nothing. However, I don't believe it's the intent of central governments or central banks to nationalize the system. They know it operates far more efficiently if left in private hands, and they also know they don't have the capacity to manage those banks effectively over the long term. And there's one other con against nationalization. If you have nationalization of the banks, the common share prices essentially evaporate to nothing. In that case, imagine what's going to happen to pension funds, because pension funds are some of the biggest holders of the common shares of banks. And all of a sudden, the value within pension funds is going to be brought into question, and their ability to meet their liabilities to the pension holders is going to be called into question as well. So there are ramifications to nationalization outside the banks themselves that can really affect the economy and the financial system down the road. I think it's a very viable option. In fact, it harks back to the early 90s when we had a real estate collapse in the US, which resulted in the savings and loan industry really disappearing. And the government initiated a company called the Resolution Trust Company at that stage, which took all the toxic real estate assets off the books of the savings and loans to avoid them going into complete bankruptcy. They subsequently sold off those assets at reasonable prices, and the government really got paid back afterwards and earned a profit on those assets. So the option of the aggregator bank is very similar to that. Let's form a government-controlled entity that will take the toxic assets off the books of the banks and go from there. However, the assets aren't a common asset any longer as real estate was in the 1990s. There are all sorts of different categories of loans out there. There are some subprime mortgage loans, there are some credit default swaps, there are all sorts of asset-backed commercial paper and other types of assets that all should be treated somewhat differently. And I think it's like trying to make a cohesive unit about what could be called a dog's breakfast. The insurance one is an interesting option and probably represents one of the best options available right now. The most difficult part of setting the strategy for that option is determining what type of premium the banks will have to pay for that type of insurance and how much of the first tranche of losses that they're going to bear before the insurance policy sets in. Because you don't want a free pass. You don't want to give the banks a free pass where they can just take all the assets off their books and give them or leave them on their books but know that they're insured. You want to have them bearing some level of risk. And of course, with the assets being in different categories within the banks themselves and the various banks holding various amounts of those types of assets, it's going to be difficult to come up with a blanket policy that applies to all banks.